Hottest stocks and help you pick the right stock at the right time. Good morning, you're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Joining me on the show is Agam Vakil. Agam will speak about the FNOQs. I'll talk about the general trade setup. If you're looking at what happened overnight, most of the indices were rather flat in trade as far as US was concerned. But Europe did see a little bit of selling, and that selling actually continued in Asia because Asia is rather muted at this point of time. If you're looking at the SGX Nifty, though recovered from the lows of the day, is still trading with a negative bias. So it's down almost 14 points at this point of time. Most of the ADRs ended with a positive bias. Look at ICICI Bank, which was up 1.5%. Vedanta was up almost 0.8%. HDFC and HDFC Bank and Tata Motors also managed to rally in trade. What didn't do well was the IT pack. Wipro and Infosys, both of them were down in trade. Dr. Reddy's also seeing selling pressure. It was down almost 1.3% in trade. Now, overall, if you're looking at how crude panned out in trade, crude today is trading with absolutely flat in trade, but Brent is below the $75 barrel per mark, and WTI is now below the $66 barrel per mark. So, the past few days, there has been immense pressure on crude. Most of the base metals did extremely well, except for aluminium, which was flat in trade. Copper managed to rally almost 1.8%, zinc almost 2.5%, and nickel almost 1.7%. And you can see the rally continue in China because copper as well as zinc are up almost anywhere close to 1.5%, and there is a rally both in aluminium and steel. And most of the precious metals are trading with a positive bias currently. If you're looking at the flows currently, FIs they bought in almost they sold in 150 crores in the cash market. DIs bought in almost 474 crores in the cash market. It's the start of the month, so FIs have actually bought in almost 3,100 crores, and DIs have been biased to the tune of almost 100 crores in the cash market. Now, if you're looking at the sectors and the broad market as such, the Nifty was down 35 points, but look at the selling that's happening on the mid cap and small cap. So when the Nifty is up on a YTD basis of 0.5%, the small cap index is down almost 20% on a YTD basis. So, and the mid cap is down 15%. So selling is clearly evident in the broader market. Some of the sectors where selling was seen yesterday, IT was seeing selling 1.4% down, and the Nifty Media Index was down almost 2% in trade. Let's see how the WIX panned out in trade. The WIX was down almost 4% in trade. Individually, which were the major contributors, basically IT, Infosys, TCS lost out yesterday. ICICI Bank was on the negative side. A little bit of contribution to the Nifty coming in from the HDFC twins. But Agam, what are you spotting on the FNO side?
That's right, Darshan. We've seen a little more weakness seep in. Nifty back below the mark of 10,600 in terms of open interest in the futures. Very little change, but in terms of the Nifty Bank open interest futures, we've seen a more decline. In fact, the third consecutive session when there has been unwinding coming through for the Nifty Bank futures. That said, the WIX, well, we have seen it move down by as much as 4%, still within that range of 13 and 14. And when it comes to the Nifty put call ratio as well, where not too much has changed there. But what we've seen is over the past few days, more and more writing around the 10,900 and 11,000 calls, and that is a continuation of trend, as you can see here. So substantial resistance building around these levels. Now, in terms of stocks that we're watching out for, we have Divan Housing Finance, which has moved into the FNO ban, restricted trade there. But among other counters I'm watching out for, NIT Technology is now bending downwards after a fabulous run that we've seen for this particular stock over the past 1 month or so. We're looking at fresh shorts building in. In terms of some other weaker counters, Voltas is the other one, also seeing some fresh shorts with a 16% increase in open interest, and several other counters such as Just Dial also showing substantial weakness. So a whole host of stocks, especially from the mid cap and the small cap areas, which have been losing out, and we're going to have to wait and watch whether or not the recovery comes today, tomorrow, or perhaps in the next few days. But that's as far as our own markets are concerned. Let's now go across to Paul Allen for the top international headlines.
The White House has now confirmed the location for next week's summit between President Trump and Kim Jong-un. It will be at the Capella Hotel on Singapore's Sentosa Island, starting, as we knew, at 9 a.m. next Tuesday morning. The Capella has a long track record of hosting top-level international meetings, and Sentosa also offers good security. Singapore also boasts long-standing ties with North Korea. The US government has asked Saudi Arabia and some other OPEC producers to increase oil production by about 1 million barrels a day as retail gasoline prices surge to their highest in more than 3 years. President Trump has publicly complained about the OPEC policy that's helped boost oil prices and drain the glut. Sources tell us it's highly unusual for Washington to ask for a specific output hike. The International Atomic Energy Agency says Iran has drawn up a tentative schedule for boosting production of uranium feedstock. The agency says the plan was outlined in a letter submitted on Monday that follows Ayatollah Khamenei's call for Iran's nuclear industry to be ready to resume work. The IAEA said last month that Iran is sticking to uranium enrichment limits under the 2015 deal. The ECB is said to anticipate a pivotal discussion at next week's meeting, and it could produce a public announcement of when it intends to wind up QE. We're told the Governing Council is likely to treat the June 14th gathering in Latvia as an opportunity to debate the end of bond buying. The ECB's program is currently intended to run at least until September, and the bank has declined to comment. Global news, 24 hours a day on air and at TikTok on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Paul Allen. This is Bloomberg.
This is the type of capitulation you need for stocks to create a bottom. That said, I think we are unlikely to see a V-shaped recovery. So I think it may take a little while for the dust to settle because there's a lot of damage that has happened. And then maybe after a few months, small and mid caps come back. In the meanwhile, I think large caps, as they have done year to date, will probably continue to do better than mid and small. And if I'm sounding now more and more like consensus, I think that's what happens after a while. So at the end of last year, we were cautious on mid caps, and I'm not saying I called a 20% correction, but mid caps did look a bit stretched, and so now we're getting that result.
What if the large caps were also to fall due to various reasons, right? I mean, you could attribute maybe a global reason to the drawdown, and we've had one which we have recovered from. But what if I know you said that the large caps would probably continue. In the unlikely scenario that the large caps were to fall, what happens to this correction carnage that we've already seen in the mid caps and the small caps? Does that worsen? I'm sorry, I'm sticking to mid caps and small caps, but the last half an hour in your conference, some of the fairly marquee managers have come and spoken to me about what's happening in the broader end of the spectrum.
So let's understand this. So the Sensex troughed at 9,000 in 2009 March. From there has had a ride which is now approximately 4 times up over 8-9 years. We've had a few corrections along the way. Bull markets have corrections which can go as deep as 20-25%. At any point in time, stocks can give up because some concern emerges, and we could get such corrections. I do think we're still in a bull market. The bull market is not ended, but we could definitely get a correction, and if such a correction happened, it may cause mid caps and small caps to go down a bit more, but I don't think they'll fall as much as large caps could fall if that correction happened. I'm not calling for such a correction, but in case that happened, because that I think was your question.
The question is, do you believe that even if the Sensex doesn't fall too much, which is your base case, the recovery in the mid caps and the small caps, can it come back? Because
of course it will. It will at some point in time.
At some point of time, everybody knows.
Some point means in the next few months, in the next few weeks. It all depends on the trailing price damage. So at the rate at which it is going, it will bottom out faster than I would have thought, say, a couple of weeks ago. So the damage is accelerating. So accelerating damage is good for a bottom. Okay. So I think it is probably happening faster than I would have thought 2 weeks ago, but it's difficult to pinpoint when. See, I'll tell you, the template to think about this is slightly different. You have to define whether you are a trader or you're an investor. And if you are an investor, then you got to wet your toes right now, okay? Because there has been enough damage to share prices. and you keep ammunition, you keep cash in the bag to react to further falls, right? If you are a trader, then you need to time this much more accurately. So therefore, you need to come in after you've seen the bottom.
Indiabulls Real Estate is the stock which is expected to be in focus today on the back of buyback plan, which has actually started yesterday. If you'd see, the company has bought an 0.6% stake from open market for a sum of around 47 odd crore. 27 lakh shares have been bought through a bulk deal at a price of around 175.58 per share, which implies a premium of 3% as per the current market price that we saw yesterday. In terms of the buyback details, the company plans to buy back up to 2.6 crore shares for a sum not exceeding 240 per share, which represents a 5.5% equity for the overall company. If you look at the shareholding pattern, promoter shareholding currently stands at 37%, while the public shareholding stands at 63%. Notably, promoter shareholding for this counter over the past 1 year has declined from 50% to 36%. Also, if you look in terms of the valuations, the stock seems to be trading expensive as compared to its own historical average, almost a 30% premium as compared to the 2-year average PE that we're looking at. It's trading currently 18 times of its current PE versus the historical PE that we have for 2-year average of 14 times.
Let's also get your check on the commodity space, starting off with oil prices, which are currently trading higher. Remember that overnight we saw a 1% surge, and in fact WTI did manage to snap its 3-day losing streak. Now this is all on the back of inventory data, which has led to supply tightening, and also that API is likely to report an inventory decline of as much as 2 million barrels for last week. As far as base metals are concerned, the index on LME ended about 1% higher. Remember, this is the 6th straight day of gains that we saw for the entire index. As of yesterday, all base metals except for aluminium ended higher, where we had nickel, where the inventory data came in at the lowest level in over a decade now. Copper prices surged on supply concerns, and zinc, which was the top gainer in trade, climbed to the highest level since April 24th. Now, if you look at the gold prices, they are actually trading above the 1300 mark once again, as we have seen a dip in the dollar index, and overnight we saw some bit of struggle for the US equities.
Let's shift back the focus back to equity markets. Bunch of stock that we're tracking this morning apart from Indiabulls Real Estate is the NMDC, which has reported production and sales number both at 4.53 million ton, however registering a decline of as much as 19.5% for the month of May over the May that we've seen last year, and sales too have seen a decline of more than 30% in this month. In terms of stock split, we're looking at United Spirits, where the shareholders have given their approval for the stock split in the ratio of 5:1. Also, in terms of the price hike, Kirloskar Oil Engine is expected to be in focus, given that the company plans to hike power generator prices by as much as 5 to 8% on the back of higher raw material prices. Next on the list, we also have the regulatory hurdle coming up for Glenmark Pharma, where the US FDA has issued a Form 483 with 5 observation for its Dhar facility. So we might just see a bearing of that on the counter. Also, we have Nalco, which has announced its capex plan for ongoing financial year 2019 and has earmarked an amount of around 1,100 crore. Separately, we are tracking Tata Global Beverages now, which saw a good reaction in previous session, but in today's expected to meet a bunch of fund houses in the likes of Morgan Stanley, Goldman Sachs and Sundaram AMC.
The June Monetary Policy Committee meeting has been one of the more interesting ones in a long time. We're at the cusp of a turn in the rate cycle, and that's always interesting to watch. And it's not an open and shut case. So what you've got in terms of expectations in the market, the Bloomberg poll suggests that the expectations are split. 14 people polled have said that there will be a 25 basis point hike in the repo rate, which will take it to 6.25%. 29 say that there will be a status quo in rates, but even within that 29, There are people who say that there'll be a status quo which will come with a shift in stance from neutral to withdrawal of accommodation. So those are the range of expectations in the market. Remember, the market has already been under stress, and borrowing costs, whether you're looking at the bond markets or the banking markets, have already been elevated. You've seen quite a significant hike between April and June itself. That is reflective of an expectation that rates will start to rise. Also fiscal pressures and reluctant PSU bank buyers in the bond markets. The reason I mention that is because if you were to get a rate hike in the June policy, it would need to come with slightly softer communication perhaps, so as to not spook the bond markets even further. So what is being called as a dovish hike may be delivered. On the flip side, if there is still a pause in rates, then it would come with a hawkish stance, suggesting that rate hikes are imminent, perhaps as early as the August policy. What are the macro factors at play? Where core inflation continues to be the core concern at about a 4-year high of 6%. The MPC will look very closely at that core inflation number, see what the momentum of inflation has been after stripping out base effect, etc. But even at the headline level, at 4.58%, headline inflation seems to be moving further away from the midpoint of 4%, which is the MPC's target. Remember, that target is a band, 2 to 6%, but the midpoint is 4%, and the MPC is yet to meet that 4% midpoint. So credibility perhaps also an element in the decision of the MPC. Now, since we've got those April numbers, which is 5.9 on the core and 4.58 on the headline, we've already seen crude prices go up even more. There's been a 12% increase between the April policy and the June policy. That will feed into headline inflation. There's also been a depreciation in the Indian rupee, which will also add to, again, inflation pressures. But on the rupee, there is also the question of whether the MPC, or in this case actually the RBI, wants to use the rate defense to protect the currency, as other emerging markets like Indonesia have done. That too will be an input into the MPC's final decision this week. Now, remember, you may not get a verdict which is entirely one-sided, so you could see the MPC being split. We already know that Michael Patra had voted for a rate hike in April. Viral Acharya, the minutes of the April meeting showed, wanted to move his stance to withdrawal of accommodation in the June policy. Does that come with a rate hike vote? We need to watch for that. Chetan Khate is the other person who could move into the tighter monetary policy camp, because he talked about structural pressures on inflation going by his inflation models. Ravinder Dholakia, Pamidua have been relatively dovish, so may not quickly switch into the rate hike camp. Urjit Patel has been very tough to read. You could get a scenario where the committee is split down the middle, in which case, remember, Urjit Patel has a casting vote. Will he need to use that casting vote for the first time in the short history of the MPC? Will be very interesting to watch as well.
As part of a plan of turning around the stressed power assets in the country, State Bank of India has actually shortlisted 11 large stressed power assets for immediate resolution. These 11 stressed power assets have a capacity of between 12 to 15 gigawatts and a debt burden that is nearly 80 to 90,000 crore is what sources are telling Bloomberg Quint. Now, as part of this resolution strategy, the government as well as the various stakeholders, including the RBI and some of the lenders, are considering three potential routes as how these companies can be turned around. The first of these three potential routes is that of a special purpose vehicle that will be floated by government-owned agencies like SBI, REC and PFC. This special purpose vehicle would take over some of the equity as well as debt of these power sector assets from the banks. The SPV would also issue government guaranteed bonds to the banks in exchange for taking over the debt of these power sector assets. The SPV would hold on to these assets, appoint specialists to operate and manage the company till the point in time that it can come back into normalcy, and then these companies would then be sold to potential bidders who may be interested in buying them at a later stage. The second route under this resolution scheme is that of a private sector led route, wherein a similar structure would be led by the private sector, including some foreign funds who will float asset management companies which will take over some of these power sector assets and then turn them around and sell it to potential buyers. The third plan that is being considered by the government as well as the Reserve Bank of India is that of a one-time dispensation scheme. Now, this is something that the RBI has been against for a very long time, but the discussions, as sources are telling us, is currently on between these two stakeholders. Under this scheme, the power sector asset would be given some kind of extension on the loan repayment scheme and may also be given a reduction on the interest rates. The promoters of these power assets would be allowed to continue to run the companies. However, they will see a significant haircut on their equity in the company. Once these assets are turned around, then the future of these of the companies and the ownership of the company can be decided between the lenders and the stakeholders. Now, going by past track record, typically the government has depended on one-time dispensations when they're dealing with sector-specific issues, especially in the power sector itself. Back in 2015, the government had approved the Uday bond scheme, wherein some of the liabilities of distribution companies, state-owned distribution companies, were transferred to the books of the of their respective state governments. However, that plan has not really panned out the way that the government had planned, and therefore the current dispensation scheme will be looked at with that lens. Of course, a lot of these details will be fleshed out in the coming weeks, but looking at the February 12th guidelines on stressed asset management that the Reserve Bank of India had issued, banks have time only till the first week of September, after which they will have to take these power assets to the NCLT for treatment under the insolvency and bankruptcy process.
There's lots to talk about over the course of the day, and you'll find all the live market action on Bloomberg Quint. There are also a few stories that you should consider reading on the website bloombergquint.com. Here they are. India may be the biggest beneficiary of solar industry reforms in China that are poised to reduce prices for photovoltaic panels. And India aims to surpass its renewable energy target by 2022 as Asia's third largest economy pushes to reduce reliance on fossil fuels. And market regulator SEBI put in place a detailed framework for listed infrastructure investment trusts to make preferential issue of units to institutional investors. And with that, it's a wrap on this edition of All You Need to Know. Indian Open is up next. Stay tuned in.